Why the American housing market is definitely going to collapse. If you've been paying attention to the casino that is the American economy lately, you might have noticed that things aren't looking so great. Inflation is insane, cryptocurrencies are crashing, and the rent is, as always, too damn high. But there is no better bellwether for the state of our state than the housing market, and I have some bad news for you. Real estate prices are on the verge of collapse, and there's not much that the Fed, Biden, Trump, or anyone else can do about it. I've spent the last few days looking at reams of historical real estate data, watching pundits pontificate on boom and bust cycles, and have been surprised at how many so-called experts remain optimistic that the real estate juggernaut is on track to remain stable for years to come, despite terrifying signs that it isn't. They acknowledge that, sure, mortgage rates are high, but not so bad by historical levels. They tell us to never bet against the American economy and that houses are in such short supply that there's no way that prices are going to go down. Don't buy a word of it. These experts were singing the same tune when we were on the precipice of the 2007 housing collapse, when they predicted that real estate values would never drop. More importantly, they are ignoring one key indicator that is as bad now as it was in the 1980s at the height of stagflation, and before that, during the Great Depression almost 100 years ago. I'm talking about the ratio between the median mortgage payment and the median American income. More than any other factor, this ratio will tell you whether the housing market is going to surge forward or lead to a startling collapse. Now, I'm going to get into some numbers in a minute to illustrate how terrible the housing market will be in 2022 and 2023 by referring to some historical prices and trends, and I'm going to put everything into today's dollars in order to account for inflation. I hope this will make things easier to understand as I make my point, but I'll also post all of the actual historical numbers and conversions down below in the doobly-doo. While you're down there, be sure to check out my newsletter so you can sign up for updates whenever I have a new video out. Hell, while you're at it, hit that subscribe button. It's the red one right over there. To understand why I think we're on the verge of collapse, we need to go back in time to the peak of stagflation in 1982, where the economy fell into a death spiral of high inflation, high gas prices, and high unemployment. This was the year that Michael Jackson's Thriller topped global music charts, when everyone was playing Pac-Man at video arcades, and the US government was breaking up the AT&T monopoly. It's also when New York, Chicago, Boston, Los Angeles were burned out husks of their former selves, struggling with the crack epidemic, high crime, and abandoned buildings. In order to rectify the situation, the Federal Reserve Board took drastic measures and increased its benchmark rate, which caused mortgage rates to cruise up to an insane 18%. This was the highest mortgage rate in history, and for reasons that I'm not going to get into here, eventually the economy came back online. As you can imagine, 18% interest also made it a pretty lousy time to buy real estate. In 1982, the median house cost the equivalent of $195,000 in 2022 dollars, while the American median income was the equivalent of $75,000. This meant that the average Joe or Jane who wanted to get into the market would have to plunk down 20% for a down payment and would still be paying the equivalent of a whopping $3,267 per month on their mortgage. The monthly income to mortgage ratio was at a catastrophic 52%, meaning that the average person would have to spend half of their money on housing and half on everything else. These insane costs are one reason that the urban cores of Los Angeles, Chicago, and New York all fell into rapid decline at that time. To put this in perspective, most economists say that it's never a good idea to spend more than 30% of your income on housing. And that's a good benchmark to keep in mind, because in 1982, anyone who wanted to get into real estate was paying a proverbial pound of flesh. It was economic suicide. But things did get better. Fast forward to 1990, and we were back on track. Mortgage rates fell to 10%, and the median home price appreciated to a reasonable $268,800. You could say that the economy in 1990 was pretty good because after you adjust for inflation, the median income was $127,000 in today's dollars. So even though they were paying $3,267 for their mortgages, it only took up 26% of their income. At the tail end of the first big tech boom in Silicon Valley in 2000, things were better still. Mortgage rates were going down, and the ratio sat at a pleasant 23%. These were great years. People wore flannel. Sex and the City was airing on HBO. I graduated from Kenyon College, and a lot of my peers were landing high-paying consulting jobs without any experience. I ended up working at a fashion magazine run by the mob, but that is an entirely other story. Other than a massive terror attack and a few wars in the Middle East, the overall economy wasn't too bad. And then comes 2007. This is when the financial industry basically broke the housing market when it created securities called credit default swaps that ultimately tanked our entire financial system. I'm not going to try to explain how it all came about. Hell, if you're watching a video about the real estate market, you probably remember a lot of the ins and outs of this crisis anyway. However, if you are looking for an exhaustive recap, I highly recommend that you listen to David Sirota's podcast, Meltdown, which you can find on Audible for free. In a nutshell, the housing market collapsed because banks were giving variable rate mortgages called ARMs to people who had no hope of keeping up with their payments. Then, when those rates went up, foreclosures swept the land. However, when I dug into the data of the crash, what surprised me was that outside of the rampant banking fraud, the income to payment ratio was rather manageable at just 20%. In fact, according to that metric, 2007 should have been the very best time to buy a house in America in the last 40 years. Median income was an adjusted $87,000, and the average mortgage payment was just a smidge over $2,000. But those fundamental economics didn't matter, because too many loans were going belly up because of poor regulation. So the Bush and then Obama administrations bailed out the banks that were too big to fail, and the Fed slashed mortgage rates to just 6%, 1/3 of what they were back in 1982. And here is where things in the housing market really went off the rails. Rather than punishing the banks for fraud by putting people in jail and imposing better regulations, the TARP program patched up the economy just enough to get things moving, but did not fix the underlying problems. Seriously, listen to the Meltdown podcast. It's really good. The result is that for about 15 years since the financial crisis, money has been relatively cheap. The Fed kept interest rates low and propped up housing prices, so on the surface, everything looked pretty good. If you bought a house, you saw it rise rapidly in value pretty much across the whole country. The thing you need to remember about interest rates is that they correlate with housing prices. If the interest rate drops, then you have more money to invest in real estate. As a rule of thumb, if you drop the interest rate a point on, say, like a $300,000 loan, then you'll save about $200 a month on your mortgage payment. But another way to look at it is that for every point you drop on the loan, you could also afford to spend about 10% more on the price of the house without changing your underlying payment. This was the fundamental mechanism that supercharged the housing market. Prices skyrocketed as more and more buyers crammed into the market much faster than we were building new housing. No one wants to wait to buy a house when the price of waiting might mean paying 20% more a year later. But just when you thought it couldn't get any better, along came the pandemic. The Fed tried to bail out the overall economy by dropping interest rates again. This was sort of insane because, remember, the housing market was already overheated. At its very lowest, you could get a loan for as little as 2.4%, which was actually under the rate of inflation. It was sort of like the bank was paying you to take out a mortgage. It was almost impossible to lose money in real estate, and the market responded predictably. People bought housing like it was going out of style. And back to those numbers again. In 2007, the adjusted median house price in America was $328,000. In 2022, it was a whopping $428,000. No adjustment needed. We have been buying housing at artificially cheap interest rates for 15 years, and for the last 2 years, money was basically free. These insanely low rates that were meant to prop up the overall economy helped inflate the real estate bubble, and it couldn't last forever. At the beginning of this year, the music stopped. Inflation hit 8%, and the Fed couldn't afford to prop up the housing market anymore without risking every other part of the economy as well. The Fed jacked up the benchmark rate, and the result is that today the average mortgage is 6%, or a little more than twice as high as it was at its lowest point. It's pretty likely that interest rates will go up at least another point by the end of the year, if not 2 or 3 more points, which would bring us back to historical norms. Right now, the median American income is $75,000, exactly the same as it was in 1982. And because of inflation, that real value is actually lower than it was at all of the intervening years. During the last economic collapse in 2007, the average American made $12,000 more in adjusted income value. Remember, that ratio that I've been talking about this whole video, the percentage of that income that someone has to pay on their mortgage, today the average mortgage is $2,624. That's a 41% ratio, well past the 30% safety zone. That's double what it was in 2007 and rapidly approaching the 51% mark that it was when New York turned into a ghetto in 1982. If mortgage rates hit 9%, which seems likely, we will cross that threshold and be in exactly the same place we were back then. It's true, there is still a housing shortage, but there's also simply no way that people will be able to afford to purchase housing at bubble prices, even if they wanted to. American buyers are priced out of the market, and the only way that they can actually manage to purchase a home is if the housing prices go down. Even if someone thinks their house is worth bubble prices, there aren't any buyers. It's simple supply and demand. So what is going to happen next? I can't give you an exact date when there will be an all-out collapse. These things usually start slowly and then happen all at once. In 2007, movement in adjustable rate mortgages, ARMs, triggered the meltdown. Lucky for us, those aren't quite as popular now as they were back then. The best case scenario is that the market will flatline for a while and then drop gradually at a reasonable pace to where the income to mortgage ratio holds somewhere below 30%. The steepness of the fall directly correlates to whatever rate the Fed issues over the next few months as it attempts to combat inflation. As I said, at 9%, the housing market would be as bad as it was back in 1982. But unlike 1982, there is simply no room to bring rates back up to the historical high of 18% that got us out of stagflation. If that happened today, the average mortgage payment would be $6,465, an impossible 105% of income. Honestly, I have no idea how bad it's going to get, but I wouldn't recommend that you get into the real estate market right now. Instead, bide your time and beware of anyone who tells you that things are fine. They're not at all. If you enjoyed this video, please like and subscribe, and also check out my newsletter and the related information and links down below. I'm going to be on vacation next week as I hunt for Bigfoot with my wife, Laura Krantz, in the Idaho wilderness. Yes, you heard that right. I am not lying. Hunting for Bigfoot with Laura Krantz. But I'll have more videos for you sometime in the first half of July. Be well, my friends.